everyone, this is Adam Thomas with SkyviewTrading.com, and in today's free video I wanted to go over how to calculate your max risk in an Iron Condor. And for those who don't know, an Iron Condor is simply a short strangle with defined risk. So if we look at the SPY option chain and we look at a short strangle, you can see we could sell the 170 call and the 164 put for a credit of 127, and if we analyze this trade, you can see our max profit up here is $127, which is the credit we took in, but our max loss is unlimited. So you can see if the S&P did go to 250, which it's highly unlikely that it doesn't, but theoretically the stock can go to infinity, your loss would be minus $7,800. So since your risk is high, your margin requirements are also going to be high from your broker, because in the case that you lost that money, you would have to be able to pay for the loss. If we set our slices at break even at expiration, you can see our break even is 179.29 on the upside and 162.75 on the downside. And if we pull up our strangle that we already have here, to turn this into an Iron Condor, we'd also buy the next strike out on the calls and the puts. So in this case, we sold the 170 calls and we also sold the 164 puts. So we are going to hold control and buy the 171 calls and buy the 163 puts. And now you can see it says Iron Condor down here, and the credit received is lower than on the strangle, and this is because with the lower risk we receive less of a credit. And similarly, if you analyze this trade, and we can uncheck the strangle here, our break even on the Iron Condor is narrower than on the strangle, giving us a lower probability of success. But at the same time, our max profit is $40 when our max loss is only $60. So no matter where the stock goes, the most we can ever lose is $60. Now it often confuses people why the risk is only $60 on this trade. Well, because an Iron Condor is basically the combination of a short call spread and a short put spread. And the short call spread, well, let's go back to the trade tab over here. And if we arrange this by vertical, the 170 by 171 is trading for 21 cents. And the max risk on this trade would be 79 cents, because it's $1 wide minus the 21 cents. So our max risk is 79 cents, and on the 164 by 163 our max risk is 82 cents. So why would it not be 79 cents plus 82 cents? Well, the reason is because you can't lose on both sides of the trade. If the stock goes to 160 and you lose max loss on the put spread, you're going to be at max gain on the call spread. So if the stock goes to 160 at expiration, this 164 by 163 put credit spread will be trading at $1, but the 170 by 171 call spread will be trading at 0. So that means the most the Iron Condor can go to is $1. So if you ever have to buy it back, that would be the most you would ever have to pay for it, is the dollar. So adding the call spread to the put spread increases your return on capital, but it lowers your probability of success versus a strangle or just a vertical credit spread. So hopefully that made sense, and as always, if you have any questions, just email me and I'll get back to you. So I'll see you all in the next update.